It's that time of the year again when wealth managers meet with clients to discuss the latest trends in trade and risk management and their investment goals. With the financial unrest the global community has experienced this year, wealth and asset managers need to treat even more carefully when advising clients. Here to take a look back at 2012 and to look ahead is Lee Cairns, partner, as I said, at Citadel. Lee, thanks for your time.
Thanks, Godfrey.
When you look back at 2012, were there more surprises than you had expected?
I wouldn't say necessarily surprises completely, because the asset classes that we were hoping to perform have performed. Perhaps it's surprising that they performed even better than what we thought they were going to perform.
It is a nice surprise.
A nice surprise, yeah. And we were talking before the show about Bernanke. He's starting to look a little bit like Father Christmas at the moment with that beard.
For the markets at least.
He's been a bringer of good news as well. So
yeah.
It's almost feels like a year that we don't want to end because of the strength in the markets at the moment.
So thank God Mitt Romney didn't win, because he did want to take out Bernanke, so let's hope he'll come back for the markets as well.
Correct.
But so let's talk about those outperformers. What were they when you look back, even though we do know, of course, that the year hasn't exactly ended?
Well, if we just look in South Africa, because I know most of your viewers will be obviously interested in what the JSE has done.
Sure.
The JSE has been a big sort of standout. Even when you compare it with world markets, I think it's up some 23% year to date.
That's in rand terms.
That's in rand terms, yes, and it's a good point. But relative to all its sort of BRIC counterparts, it's had a fantastic year. If you look at the disparity between the JSE's performance versus China, even, it's been phenomenal. So a very positive year, and then within that, certain sectors, the industrials have just had a storming year. And I guess, why we're having this conversation, why people want to hear about, why you have a conversation with your advisor is not to make predictions on the future as to what you've just seen in the rearview mirror.
Yeah,
so, do you stay heavily invested into, the Naspers and Aspens and Richmonts that have been so phenomenal this year, or what to expect when you come back from your holiday come January 2013?
Absolutely, we're going to get into that conversation. But let's look back on those industrials, because they did seem to surprise some people. You're suggesting that they didn't surprise you, but some people are beginning to talk about froth creeping into that market and perhaps a bit of overpricing from where Citadel sits. Do you guys get the same sense?
Yeah, they definitely have still got some potential to maintain their levels at the moment, but as value investors at the levels at the moment, they'd certainly make us nervous. So when you're looking at your entry point as to what price you pay for an asset to get into, I'd be quite nervous as I'd be an investor into it. I don't have too many of the pundits out there that have them as a strong buy, so perhaps a hold to take some more of the profit that's probably going to come through because of the positive sentiment in the US that seems to be carrying our market. But as a new investment going in, I'd be quite nervous. Godfrey, it's a level that it makes us feel a little bit uncomfortable. The JSE's never been driven by industrials before. We've always been at record highs because of the resources. The resources are actually low, and yet we're at these record highs.
So let's talk about those resources, Lee, because they've been a surprise, haven't they? Particularly given the fact that, yes, we do know about the mining unrest and all the other issues that these guys have had to deal with. So your expenses are high. We had commodity prices that were under pressure at the beginning of the year, but now we're beginning to see that changing. At the same time, also, importantly, we've got a weaker currency, and yet the resources don't appear to be galloping in time or in tune with the rand.
No, they're not. And that's where there's an opportunity because of the disparity there, that if you think about, does it make sense? Well, it doesn't make sense to us at the moment, why that is. So, if you believe in the recovery, which seems to be the muddle through globally, and that the resources, the demand for it is going to sort of pick up from the levels that it's been very depressed to over the last 2 or 3 years, then that's definitely a very positive place to start, to say, what is the value here, and what is my strategy, and if I'm going to put some money in here, not having to depict whether I'm going to get profit over the next 6 months, but maybe over the next 2 to 3 years. There wouldn't be much better place as a starting point than those resources.
How much, though, do you think is being priced into this in respect of the general perception that South Africa is not a very good place to do business? The whole general perception about corruption, then of course the political situation and all those other things.
Look, Godfrey, I speak to quite a few of my clients who are in mining, and they've certainly noticed that some foreign investors who would have been an obvious starting point in South Africa are now looking up the west coast of Africa, and they definitely they've got a bit more market share of ours than they would have, which is a pity. But it's a small moment that Marikana has caused this doubt, and I think that hopefully Mangoang and a few other things will give some peace of mind whenever there's a political agenda going on, a wait and see sort of approach is taken. So I think, with the other positive sentiment, you said, a lot of that clarity that will come out, that perhaps even those foreign investors will get to January 2013 and say, well, now we've got some answers to the things that we've been waiting to see,
Yeah.
and that we see a lot more of that coming into the mining houses that are still, world leaders that are based here.
Yeah, we'll certainly be watching Mangaung. I hope we'll be watching CNBC Africa, because we will be broadcasting the breakfast from 7:30 until 8:30 a.m. from the 17th actually to the 19th. But let's leave that for now. Let's talk about those sectors, or at least those of the JSE. At least let's stay within equities of the JSE. That surprise on the downside.
That surprise on the downside, well, only just of late those resources have started to sort of do something. So I think overall, from an entry point at the beginning of January, they've been disappointing in relation to what the industrials have done.
Sure.
I think cash has obviously been the safe haven, but if you've been in cash, you've lost out terribly to inflation, especially as the rates have fallen.
True.
So after your income tax, you've sort of got next to half of inflation, so loss of half of real value. But within the JSE, there's been nothing that's been aggressively disappointing. I think it's depending on what you're comparing it to. So if you've held a decent share in the JSE, it would have done fine. I think if you compare it to a Richmond or a Aspen, it would have been disappointing. But still, from a real returns point of view, would have had a fantastic return.
Before the program started, we were talking about the fact that the indices this year have also been quite outperformers. In fact, if you had put your money in the indices, you were saying to me you would have outperformed most fund managers.
Yes. We had this conversation on the show a few months ago with regards to active managers and their ability to outperform, and there's only very few actually that ever do. But the good ones, in South Africa, an Investec Value Fund, they outperform significantly, so they are worth looking for. This year there's been even less. So when you talk about costs, and we have this conversation with our clients all the time, in a sort of medium to low yield environment, how those costs are important. If you'd bought the ETF of the JSE, I think you would have been very hard to beat. I think you would have been probably one of the top, if you called yourself a manager, one of the top managers around. So it's just been one of those different years. It's been quite difficult to predict. The top 40 has all sort of moved in sync with each other. So if you could have got into most of those at the lowest possible cost, you would have probably got the best net outcome of that.
Yeah. So we have now the JSE, of course, trading at a record. But let's take out the equities and look at the whole investment spectrum. Within the asset classes, where would you have been safer putting your money? Is it equities?
Equities has been by far the best performer.
Sure.
South African bonds hasn't been bad, and also the offshore bonds has been surprisingly okay. So when I say okay, it means that they've given real returns as well. So we've just been looking at people that have been scared since 2008 and sitting in cash. What are your alternatives? And anything that's been an alternative to cash, what's given you real returns? Listed property has been okay as well. And the bond space has been decent. But you can't compare anything to equities, and it's gone exactly like what the old stalwarts have been sort of followed, like a Buffett who tells you when the market's most scared, you should be looking. The opportunity was there. It was looked the most unlikely to be, give the returns, and yet it has. So once again, that old story about the sentiment when it's the most negative, try and go against the grain, because that's probably where the biggest opportunity is going to show itself this year.
Yeah. So let me sum it up. It's been a good year for equities.
Yes.
2013, same as before, or should we be scared and get really careful about where you put your money?
No, you should. I think if you look at an investment philosophy within equities, I'm expecting something quite different. So it's been a year which has been driven a lot by the growth funds. So Apple, until recently, if you look offshore, has been a big driver of markets. And locally, it's been the Naspers and Aspens and ShopRite and Mr. Price's, the growth stuff. I think there's still a big expectation from equities, but for me, the big opportunity now is in the discounted value shares, which are still can be found around the globe. And locally, it's the resources. They still are underpriced. Abroad, you can find some fantastic multinationals in Europe, trading at very low PEs, just because of the negative sentiment around Europe, which is now dissipating, but the market hasn't yet moved. So value investing, looking for what's underpriced and what hasn't moved yet because the sentiment's driven it to those levels. So yes, equities, but very specifically though within a certain philosophy within equities, because value's been held back for one of the longest periods that we've seen for a while, and it normally doesn't stay that way and when it corrects, it's normally very aggressive. So don't miss out on that opportunity at the moment.
So broadly, is that the Citadel house view?
Yes.
So let's talk about where that surprise is likely to come. Of course, we're always looking to outperform. So if we can perhaps predict, I know how difficult that can be, but if we have to look into your crystal glass, where would you say the surprises are likely to come? Is it here in South Africa? Is it abroad?
South Africa, what will surprise us is probably rand strength.
Sure.
You know, that it got oversold, and again, we spoke about on the show a while back, there was a lot of nervousness at 880 and 890, people wanting to suddenly get money offshore at that level.
Yeah.
I think if you're looking at a year next year how the rand favors against the dollar, it'll have a very good year, so that'll be probably a positive.
Give us your forecast for next year for the rand.
We don't give sort of forecasts, but I'm predicting that a fair value for the rand should be at, you know, between 810 and 830. So
Right.
if we look at 865, you can get a
Okay.
you know, improvement of 4-5% from where we are currently.
Would you still advise clients to take money abroad at these levels? Because that's
Yes.
where we are now.
Absolutely. So one of the things of old that we've always done in South Africa is we've waited to time when the rand is what we think is fair value to buy a dollar, and you spend time waiting and missing out on market movement. So before we used to have to wait until it was a fair value to buy the dollar. Now we buy the offshore assets that we want, but just hedge out the currency. So most
Right.
of the assets that we're buying at the moment, we're holding in rands. And when the rand's at a better value, and it's somewhere between that 810 and 830, if the environment stays the same now,
Okay.
then look to hedge out and hold that dollar currency, which is where your permanent sort of position would want to be.
Sure. And within South Africa itself on the JSE, let's try and find that value.
Well,
Is
if I
it
can-
hard though to look for that value though now?
I don't think so. So, you know, if I take off the top of my head 5 shares that are all trading under P's of 10, Sasol happens to be one of my favorite shares in the world, let alone in South Africa, when it is already the value it is, and then it's offering a 4.9 or 5% dividend.
Yeah.
Anglo, BHP, Anglo Platts is something that suddenly has got a little bit more support, which surprised me how long it's taken to, but again, a very low multiple that you're buying it on. Sign off a fantastic company, you're doing some very interesting things offshore, again, a P of 8. Sun International as well is also showing some value, and it's recovered quite nicely just over the last 2 months. So, no, it's not actually that difficult. I think you can be a bit negligent if you just assume that the growth we're seeing on the JSE is going to keep on because of the positive sentiments on emerging markets. If you take a little bit of time to decipher, well, what looks overpriced and what's underpriced, there isn't a lot in the middle. There's a hell of a lot that looks very good value, and there's a hell of a lot that looks very expensive.
Yeah.
Just sift out those, and there'll be some very nice surprises there.
I'm picking a preponderance of the resource shares
Yes.
in your picks for 2013.
Yes. My picks for outperformance in 2013 would probably be Exaro from today's price. I don't know what it'll be by the end of the year. So if it's on January the 1st.
I'm hoping to bring you back next year this time.
I just believe, you know, in a lot in what they do. So energy is Sasol, so it's too depressed, given that we're thinking the world's recovering nicely, and therefore energy is a good story.
Sure.
Anglo Platinum, what we do in Citadel is we look at the macroeconomic story, and one of the things that gives us positive sentiment is the number of car sales, and those have been picking up very nicely.
Right.
So your catalytic converters and your Anglo, and is that depressed price of platinum about to start picking up? I think so, yes. So there in those three, you know, that's personally where I'm.
Okay, so you're going to put your money in those, but where would you be taking money out of now? In other words, what are your dogs for 2013?
Some of those industrials that we spoke about, and I don't want to sort of diss any company because, you know, good management, but sometimes the price is just too heady for what they're doing. So, you know, Mr. Price for me just doesn't make any sense at all at the level that it's at the moment. I was going to mention
Mr. Price actually as well.
Yeah, so you may have seen the article with a comparison to the construction sector and how quickly that sentiment has changed the 2007 story to now.
Yeah.
That doesn't make sense to me, and I know that a lot of the foreigners are driving that share price at the moment with their assumption as to the potential of Africa, and that Mr. Price is one of the best positioned companies to do that.
Right.
But I do think that you're probably paying a bit of too much of a premium for the potential of what they can unravel. In
ShopRite at 200?
Yeah, also looking quite expensive. Perhaps a little less headwind than a Mr. Price, but I'm reluctant. I'm not a holder of ShopRite, so new money into ShopRite I think is quite risky as well. Again, you're paying for the future of what they might do is already priced into your price that you're paying for today. And of course, if any of that success that's been predicted doesn't happen, your share price is going to go back quite aggressively.
Okay. So Lee, your final thoughts then in terms of the broad themes to look out for 2013?
One is, don't wait to invest offshore, because I think we see some great opportunities in European listed property, European listed equity. Those are two of the big areas that we think. Go into those areas, but don't wait for the rand to be at 810 where you think it to be fair value, because by the time it has, those asset classes are probably going to have moved quite a bit as well. So find a mechanism to invest into those asset classes and just be able to hedge out, which there's a lot of sophistication out. The world's changed where you don't have to be handcuffed by the currency to wait at that timing if the timing's right. And then the JSE, don't be too negative on that side as well. So if you've got existing money here and it's serving its purpose, dividend yields are better than cash. The JSE's got plenty of opportunity there still. Just decipher between the expensive and the cheap, that's all.